All right, excellent. Now that we know how to calculate a stock's return and assess its risk through its variance and standard deviation, we are ready to introduce an important concept. We said, everything else being equal, rational investors want to maximize their returns, correct? Okay, but we also said a rational investor is risk-averse. People don't like risking their money. They want less uncertainty and more clarity for an investment's rate of return. Rational investors are afraid that a risky investment would cause significant losses and want to invest their money in securities that are not so volatile. Great. It becomes obvious that the two dimensions must be combined. Rational investors want to maximize their rate of return and minimize the risk of their investment. So they need a measure of risk-adjusted return, a tool that would allow them to compare different securities, as they will be interested in investing in the ones that will provide the highest return for a given amount of risk. This is how William Sharpe came up with his famous Sharpe ratio. It is a great way to make a proper comparison between stocks and portfolios and decide which one is preferable in terms of risk and return. Here's how the Sharpe ratio looks. In the numerator, we have the excess return of a stock. We have to subtract its return from a risk-free rate. And in the denominator, we have the standard deviation of the stock. If we increase a stock's expected rate of return, its Sharpe ratio becomes higher. And analogically, if we increase the stock's standard deviation, its Sharpe ratio becomes lower. Makes sense, doesn't it? This allows us to compare financial securities and portfolios fast. In addition, it allows us to understand if performing a certain investment fund is satisfactory on a risk-adjusted basis. A fund could claim they outperformed their peers. However, we should know that often this comes at the expense of a riskier portfolio.